Is this all-time high pullback an easy buy, or is the setup too good to be true here? I mean, we've got the Fed behind us now, and there are lower expectations of volatility on a shortened holiday trading week for Good Friday, so my impulse is to say, of course it's buyable. We all know that markets only move in one direction anyhow. So in all honesty, let's take a look through a couple of the data points this week and build a game plan based on logic. Check out the links listed down below in the description, hit the thumbs up button, and subscribe for 100K by May, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. A little bit pressed for time today, so we're going to use an updated format, a little bit abbreviated, if you will. You can let me know in the comments section if you prefer it, actually, but let's kick things off here on the weekly time frame chart. Structure is, of course, bullish. We've got a very strong close at the highs of the weekly range, not enough upper or lower wick to read into. Bar to bar count is bullish in terms of location, higher low, and a higher high. If we were thinking about where the sellers maybe had an opportunity to produce a stronger weekly pullback, I would have thought after a bearish inverted hammer that was an inside bar, inside of an indecisive doji, a breakdown through those lows could have ushered in a stronger move to the downside. Obviously, you can see last week, we've closed up and over the top of the container bar range, which technically constitutes a bullish breakout. So buyers are in control, and although there is no indication of a pullback looking imminent, because we've printed a new higher high, we can afford a higher low on the weekly time frame chart, and the trend will not be jeopardized. The key level that we're watching for the coming week's worth of trade really hasn't changed. It's the top of the 2-week balance range from back here. If we can produce that higher low, it's over 502, 503 is a little bit of a 1-point zone. It's also the beginning of the NVDA earnings gap, and if we take out the Fibonacci's from the pullback at the very beginning of the year to the latest all-time high, you can see the 38.2 is directly at that level. So 502 key zone for this week's higher low if there's an Armageddon style sell. I'll show you on the daily chart why I don't necessarily think that that's going to be the case. If we do want to reference the line in the sand, the larger line in the sand on the weekly chart, just as a reminder, it's 480 over here, the top of this as a weekly balance range, and also confluence with the previous all-time high. So 480 hasn't really changed, but I don't forecast it being in play for the coming week's worth of trade. 502 is much closer to being within striking distance, but even a stretch to the downside, if you will. Let's take a look at the anchored view apps on the weekly time frame chart. Really not much to talk about here. Over time, this may provide confluence at the top end of the 2-week balance range, but we're not there yet. Let's take a look at the volume profile, and what do we see over here? There's actually a very nuanced take where this high volume node, we closed underneath it on the bearish inverted hammer, and in the lower wick of last week's bar, we used it as support and pushed in the upward direction. The main takeaways here on the weekly time frame is that the buyers clearly remain in control, and there are plenty of reference points to offer weekly higher lows and keep the trend up on the higher time frames. Let's drop it on down to the daily time frame chart now and really evaluate what we should be expecting from this week's expected move. If we take a look here, and if you're not familiar with this study, by the way, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is going to be at 526.66, implying a higher high. It's a new all-time high as well. If we're contained by the lower bound, the number's at 515.76, implying a higher low. So expected move does strike me as being bullish. In terms of the daily trend, we've got a cluster of lows, higher lows, and ideally, higher lows are going to be found over 517.25. I don't necessarily think that that's a pipe dream. I think it's reasonable considering that this is a daily balance area. Remember, we had a neutral daily trend in here. We're back to an uptrend, and just, very clearly, just to put it out there, we are pulling back from the highest high in the trend cycle. It's a new all-time high. So I believe that there's the opportunity for a gap fill reversal over 520.60, or if we do retrace some of the thin structure from the FOMC breakout, that's Wednesday of last week, finding buyers at 517.25 over the top of this as a balance area would not be unreasonable. On the hourly chart, we'll look for reversals off of that area, then trade back in the upward direction. Are we pulling back from a reasonable location? I would tend to think yes, right? Typically, when we have a balance range and we break out of it, we try to look for a range double. And a range double would have taken us closer to like 525-ish, and I think we were only off by a couple of pennies here on the Thursday high of day. The other reason why I'm not necessarily convinced we have stronger sellers entering this market still is look at the activity by itself from Thursday and Friday, right? Thursday's a huge gap up. Keep in mind that this is last week's expected move. So a huge gap up after the breakout of the expected move high on FOMC. So in theory, if the market was sort of respecting gravity and it wanted to see some gravitational pullback down towards the expected move to sort of satisfy the options traders, right? You would have thought there would have been not much of an issue rotating through the thin structure to close the gap all in one day. I mean, that range really wasn't all that large relative to what we saw on Tuesday and Wednesday's FOMC breakout. So we don't fill it on Thursday, and the sellers even struggle on Friday to produce a very strong intraday downtrend. It's really just sideways activity with a little bit weaker of a close into the 4 p.m. bell. So my thoughts on the daily time frame chart are that priorities are looking for a gap fill reversal here, or if we do retrace a little bit further, looking for 517.25 to also act as support, keeping us above the top of the balance range over here. It wouldn't be pretty, but it wouldn't also be the end of the world to find a higher low off of 515.25. And it's really just because it's confluence with the lower edge of the weekly expected move, as well as the highs from the Monday and Tuesday session of last week, lows of the Wednesday session. It would be a 100% retrace of the FOMC move, but just notice how there's still just such a strong opportunity for a daily higher low at that level. So I wouldn't throw in the towel there. The bears really build much more of an edge on the daily time frame chart for the possibility of a reversal if there's an equal low to 512 and then a lower high underneath 517.25. In that case, absolutely, you're starting to build out. There's your head and shoulders, there's your lower high. All it would really take is the break of, I don't know, it might be a neckline this way, it might be sort of more horizontal depending on how it plays out. And I guess, sort of we're speculating here, that's the key component, is this is really a back pocket situation. Based on all the evidence I can see on the daily, it doesn't seem like we have stronger sellers really getting involved. Let's move on down to the hourly time frame chart to continue to get granular here. As we can see, the hourly trend is somewhat twofold, right? The major hourly trend is definitely up, just like the daily, with consecutive higher lows and the offering of a higher low here on the gap fill reversal around 520.60. However, the minor trend is actually down, where we have highs, lows, and lower lows. So if you're going to reverse this minor trend, there's really one obvious thing that's jumping off the page at me. This can clearly turn into a double bottom up and over this neckline, which is at 523. We're back off in the upward direction, looking for blue sky territories. The other really interesting takeaway here is if there is slight continuation, but then a rebound back up and over 520.60. I mean, obviously from a pattern point of view, right, it's just a very simple inverted head and shoulders, but think about why this head failure is so important. As we look left, this is incredibly thin structure from the FOMC breakout. Again, the fact that the sellers were unable to close this gap in a more meaningful way, the fact that it took 2 days, if we find an arbitrary higher low inside of the thin structure from FOMC and then a higher low here, over 520.60, it's game on basically for me at least, up and over the neckline. I'd be very, very interested in that as a possible setup. So where do the sellers actually have something going on the hourly chart? I mean, they do have the downtrend in force as of right now. And if this is going to continue, we're looking for an equal low breakdown. Like, don't get it wrong. We can certainly trade shorts on a lower high underneath 520.60, looking for support at 517.25. I know that sort of goes against the arbitrary higher low we just talked about for the inverted head and shoulders. But if you look at me and you're like, Matt, I don't take a word you say as being gospel, then fine. If you want your lower high, trade shorts by all means on a lower high underneath 520.60, but don't overstay your welcome when and if we test 517.25 and start to show signs of buyers, right? When we get down here, it's the exact same thing. Where's the double bottom? Where's the inverted head and shoulders? Where is the very simple hourly hammer candle, right? So that's the downside. If we're going to go further than that for okay, bears are actually making something happen, just like on the daily time frame chart, it's the same concept, right? All we're looking for is a huge breakdown to get to here somehow, and then a lower high. You're looking for a double top over here, head and shoulders regular, you're looking for an inverted hammer. All of that stuff flies for possible bearish reversal and daily trend change if we get the equal low to 512 and then the lower high here at 517.25. But again, let me just remind you, as we look at this chart objectively, is there really strong sell-side momentum as we're breaking down, or I shouldn't even say breaking down, but pulling back from a gap up from a 2 sigma move outside of the weekly expected move? Absolutely not. So I just continue to see a lack of evidence for stronger sellers trying to participate. For me, this would be a primary outcome. This would be a primary outcome. This, we could trade that maybe if the day is correct and the market internals are also correct, maybe there's a short there, but this is still the primary outcome in white. I would just put in a little red dashed line here for the opportunity for a short scalp, but not overstaying our welcome at the 517.25. I think we've been fairly clear about that in the episode so far. Let's take a look at a couple of nuanced takes here. We're going to bring out the Fibonacci's from the last higher low to the latest highest high. And you'll notice that the 61.8 is loosely aligned with that 515.25. So if you wanted to use that as a line in the sand, remember that the more time you spend underneath the 61.8, the greater the likelihood of a 100% retracement. So if you're trying to remain bullish on this market, and we're just doing the dance a little bit sloppy here around 517.25, you could look to the 61.8 to be a little bit of confirmation, if you will, to either stay strong and respect the bullish pullback or throw in the towel and say, it wouldn't be unreasonable for this, and then the lower high, right? So I would use that perspective from the fibs there. And then if we come in from the FOMC low to the newest all-time high, beautiful, 38.2 is right there at the 520.60 level. Technically speaking, this would constitute bull flag consolidation, and we're looking for continuation into all-time highs. Let's clear that up and throw on the intraday anchored view apps, and then we will take a look at some market internals here. These are somewhat interesting. I don't know that we have perfect confluence at any one given level. The all-time high anchored view app will just be slightly interesting. Again, if we can clear this as a double bottom neckline, we would, by nature of clearing this level, be over the anchored view app. So that does strike me as being helpful. Maybe over time, this offers confluence at the 520.60, or better yet, if you're going to get that arbitrary like breakdown to a higher low, technically from here to here, but then come back up for the higher low like that, for the inverted head and shoulders we were just describing. If that's confluence and that low is off of the anchored view app, yeah, sure, put that in your back pocket as supporting evidence for the buyers remaining in control. Over time, may be interested in seeing if this flattens out here and just offers, a slow and steady anchored view app somewhere around that 517.25, but we're not there quite yet. Let's take a look at the market internals for the S&P side of things. You'll notice that we never actually had strong volume outflows, which should make total sense considering we had a 2 sigma move in the upward direction. But even on Friday, where it was more bearish than any other day of the week, no volume outflows. The net flows on the week were pretty close to substantial, 417 million on the positive side. The advanced decline line on Friday drifting down into negative zone, but not into trend lower zone below negative 1500. And the tick was really more so compressed than bearish. If I zoom in on this actually, notice how we just clung to the zero line most of the day. We got a little bit of a bearish read here, but remember that negative or positive in the case of an upswing, right? 5,000 is the substantial read. By the close, we were at like loosely negative 2,300, so hardly even half of what we would call meaningful. And again, I think that all this comes together to just support the idea that we do not have stronger sellers entering the market as of right now. Let's finish it up with the market profile for the ES at least, and then we'll take a crack at the NASDAQ. You can see, and again, if you're not familiar with this screen, check out the video tutorial in the top right-hand corner for market profile. If you're interested in the market internals, I'll pop that one up when we get to the NASDAQ. But for now, out of the ES market profile, notice that we do have the possibility of overhead supply based on what happened from Thursday and Friday. So if we do not hold up for the gap fill reversal here, if we do get that lower high underneath, it's totally a reasonable outcome to trade short on that lower high into. In the ES, the level is loosely around 52.50, right? That would be the retest of 517.25 on your SPY cash ETF, right? You can see the thin structure, volume at price is very thin, and the point of control and the majority of the volume from the Wednesday FOMC session is actually lower in the individual session. So if buyers positioned down here are going to be A-OK, a retest to the top of the range, again, 52.50 in the ES and 517.25 in the Spiders cash, I mean, we're all good. Like the majority of the positions are being held, at least from FOMC day, underneath the big break. So buyers late to the party can act as overhead supply, but it's really looking like nothing more than a pullback based on all of the evidence that we've sort of gathered so far. Let's jump back on over to the charts here. We'll fire up a weekly time frame chart, head on over to the QQQ, and we'll keep this show on the road. What do we see? Let's go clean. On the drawing set, the trend is definitely up. Strong weekly bar structurally, equal lows, and a higher high on the bar-to-bar count. This, as we know, and we'll see this on the daily, is a very clear balance area. So a little bit more neutral on the daily. I would still argue that the weekly trend is up with lows, higher lows, higher lows, higher lows, and an offering of higher lows. Along the way, highs, and higher highs, kind of sitting at those equal highs, which sort of, the threat on the weekly chart, if you will, would just be a daily balance range breakdown, and that maybe offers a bit of double topping activity. So if we were to take out these lows around 433, we'll see that very clearly on the daily chart in a moment. Maybe that gets a little bit dangerous, but as of right now, strong close near the highs of that weekly balance. If we continue to break out, that is into blue sky territories. Let's take a look through the lens of a couple of Fibonacci's. We'll do the same thing as the S&P's coming from here up to the most recent all-time high, 38.2. All of this consolidation is taking place above. So technically speaking, that is bullish consolidation. Let's bring out the fib from the low up to the new all-time high. It's basically an equal high, actually. It's very, very very, very short-lived new all-time high. 38.2 is still confluence with the top of this as a balance range, and that would really be the stronger line in the sand on the QQQ weekly, closer to 410, we'll call it just for round numbers sake. As we know, backing this off, it is not quite confluence. It's a little bit under, well, this is above, this is a little bit under the previous all-time high as confluence around that 410. So 410, 408 as a little bit of a zone, larger line in the sand on the weekly time frame chart. Let's bring out the anchored view apps just because we've gone more sideways. Let's see if these are playing catch up to any meaningful zones. Getting pretty close, getting pretty darn close. This anchored view app over time, if that can start to act as confluence here and we're continuing to use it as support, I would think firstly, danger. Why can't we get a higher high first? I would prefer to see the higher high first. And more so on the weekly chart, the takeaway here would actually be, don't burn me at the stake, but this actually looks a little bit bearish, right? If this continues to consolidate, or like even worse, let's go worst case scenario here, right? We pop to make a new all-time high, fail back into the range, and then this is confluence over time. Breaking underneath that starts to get dangerous for a larger weekly pullback. Again, it's a little bit speculative right now. I would still argue that the bulls are in control on the weekly chart out of the Qs, but just a back pocket idea to have as we move forward over time. Let's take a look at the volume profile out of the QQQ and see if we get the same indication off of this range. Yeah, so notice how we use that as support. So once again, a little speculative on the bearish take we just had there with the anchored view app, but so far with the volume profile looking pretty good back in the upward direction. The more we can consolidate above that node, the higher the odds for continuation in the upward direction. Ideally, a weekly higher low would be like over the midpoint of the daily range. So let's take a look at that now and really start to dive into it. So QQQ daily time frame chart. Let's take a look at the weekly expected move up first, and then we'll continue to rifle off through some other charts here. We've got ourselves a new all-time high projected at 452.76 and a new higher low from here to here at least at 440.02. Technically speaking, it's 440 on the money. I just wasn't able to be as precise with the level there. Let's do it together just to have some laughs. I know we said we were going to be fast, but there you go. 440 is technically the lower edge of the weekly expected move. So on the daily chart, the trend is still neutral technically. It's very difficult to call this a strong uptrend. This is a balance range, and if we can find a higher low, so a couple of different takes, right? Obviously this as consolidation is tradable in the upward direction. That's a break of this as a balance range. The measured move target there is a range double, just like what we had in the S&P, and that would bring us closer to 460 just based on a very quick eyeball test. So clearly a move through the upper edge of the weekly expected move if we get continuation in the upward direction, right? And that's coming from higher low up and over 448.50. If we do pull back a little bit further, so let's just say that this continues to move in the downward direction, I would be very interested in holding up over 441.50 if the buyers are going to remain in control. Really don't want to see it underneath that. There have been a lot of different intraday inflection points off of that level. We'll see this in the hourly chart. Getting underneath, I would start to think that this is like no man's land in between here, and definitely much more dangerous on any lower highs or any price acceptance underneath 438.50. It is projecting a move underneath the lower edge of the weekly expected move, but hey, we can talk about 460 being a range double. We can certainly talk about the opportunity potentially for a lower high underneath 438.50. In terms of daily structure, similar comments to the S&P, where on Thursday there's a little bit more of a meaningful gap close out of the QQQ, but it still doesn't close it all the way. I mean, it's more than 50%, but not all the way there. So stronger sellers getting involved, and not really. And then on the Friday session, instead of closing red like the S&Ps, we actually closed back inside of the Thursday range. And it's not quite a perfect gap fill reversal, but it's pretty darn close. So if this is the first indication that the S&Ps might also get a gap fill reversal, QQQ staying over 444.50 would be bullish for the S&P, staying up and over 520.60, right? So that's how the two would work in conjunction into the early stages of next week. That's really all for the daily chart. Again, keep it simple here in a daily balance range, either break and double, or looking for a higher low to remain constructive. Higher lows here are how we trade that outcome in the upward direction. Here is the hourly time frame chart where we can really start to dive into that 441.50 level, right? You can see prior resistance, turn to support, resistance after. Remember, this is the huge bearish engulfer on the daily chart. It was the lower high into the afternoon, then support for the higher low pullback, rejections into that Thursday-Friday interaction, and then of course you can see resistance. FOMC sort of blasted right through it. So if we're going to get a higher low, really interesting component about that is that it's also the arbitrary higher low through the thin structure, just like the S&P off of the anchored VWAP, right? So notice that this, it does make sense based on previous structure, but in terms of the FOMC thin structure, if this is going to be the higher low, beautiful, makes sense based on everything we just discussed, but also it's a lack of the sellers being able to rotate through the thin structure on FOMC. Let's zoom in a little bit more on this actually, make it more front and center so you guys can see it. There we go. So all good on that front. Let's bring out a couple of Fibonacci's here. Let's talk about this. Obviously, 50% retracement is actually right on the money to that 441.50. That is interesting to me. And the 61.8, although not perfect confluence, is closer to the 438.50. So if we were to violate that to the downside, again, this is sort of like kiss it goodbye. NVIDIA earnings gap is the huge threat to the downside. 438.50, huge level for that reason. Makes sense based on the fibs. 38.2, kind of similar in terms of distance from the actual level as the 61.8. You get the idea here at 444.50. Beautiful gap fill reversal. So let's talk about trend. We sort of skipped over that on the hourly chart to start. So lows, higher lows, opportunity for a higher low coming from the highest high. Short-term trend is down. Minor trend is down, just like the S&Ps, where we have highs, opportunity for lower highs, lows, and lower lows. So just like the S&Ps, all of the same patterns really apply. Breaks back over this as a neckline. Just to give you the number here, we're talking about 447.20. 447.20 would be the level that I would use. Let's use the proper tool there and try that one more time. 447.15. Let's go 15. I like 15 because it's not so close to 25. I won't feel as tempted to go round numbers only. I think that's pretty reflective of the hourly close and open there. So double bottom is constructive over that neckline, looking for blue sky territories. And remember, this is a balance range break on the daily time frame chart. Let's pull out our intraday anchored view app just to sort of wrap things up here. And I think that this is beautiful, right? Notice that all of this is basically confluence. All of these anchored view apps are confluence at the 441.50, which, as we just discussed on the daily, is more so a critical line in the sand. If we can stay over that, it's definitely more bullish than breaking down underneath into no man's land. Sellers, if you want to have something going on, this could be the bearish break, at least for a scalp, right? You can scalp that in the downward direction. Let's use our little red dashed crayon. Beautiful. When we get here thinking about the opportunity, instead then for a double bottom reversal, let's get that unhighlighted. There we go. Inverted head and shoulders, whole 9 yards. Stronger sellers, you're looking for consolidation here. Breaks under 438.50. Kiss this thing goodbye again. The NVIDIA earnings gap is a huge threat to the downside underneath 433.75. Next up, we've got the internals for the NASDAQ side of the market. Do we have anything impressive happening over here on the sell side? The answer is no. Even less damage was done on the Friday session out of the NASDAQ, which makes sense. It closed green anyhow compared to the S&Ps. You'll notice that we do have a stronger move towards trend lower zone, but not into trend lower zone, a little bit stronger of a cumulative build in the downward direction. All this is interesting, which to me might suggest that, okay, the NASDAQ technically did not break out of the range, right? This as a larger range. So with more mild internals on the NASDAQ side of things, I'd be much more open to the idea of coming in for a higher low retest over the midpoint of the range and holding that 441.50 based on the selling pressure we can see here on the internals at the exchange level. Look at the sort of ticks, if you will, on the NASDAQ compared to the S&P. This is a huge divergence on the bear side for the NASDAQ. So although we're bullish on the structure and what we just sort of talked about on the offering of a higher low over 441.50, I think we could definitely test it based on this information and the lack of more neutrality on that Friday session, even though the price action was not necessarily as bearish as what we had out of the S&Ps, right? So to sum it up and to stop talking about the NASDAQ, I would say that this is totally a reasonable outcome, but when and if we get here, thinking about the reversal back in the upward direction. Let's finish it up with the market profile on the NQ futures. And what we can see here is the same concept, overhead supply, possibility for overhead supply. In both instances, we do have poor lows on this session that has been repaired. This is a poor high. This is lack of material excess and a poor high on the Thursday session. So I don't think we discussed this directly on the S&Ps. I think we got too caught up in the overhead supply narrative, but this is the improper end of the auction at the all-time high. Just have it in your back pocket. Doesn't mean it needs to be repaired today, tomorrow, the next day, next week, but over time, this, when tested, we should look for a break through it instead of some sort of rejection off of it. So we're bouncing around quite a bit today. Let's jump back on over to Thinkorswim and let's move on over to the IWM for our small caps. Taking a look at IWM on the weekly time frame chart, let's clear up this drawing set to see it with the utmost clarity. There we go. The weekly chart has sort of continued to hold this as a key zone. It's the top of the long-standing balance range, but most importantly, it's the double bottom neckline from over here. That level, 199 to about 200. You can see that we've got mostly an indecisive doji on the weekly chart, a little bit stronger close compared to right at the opening print, but substantial upper and lower wicks. Both of them are larger than the actual candle body itself, which leads to a little bit of sort of open-minded to either direction here, trying to remain bullish for lows, higher lows off of that key structure that we just described, but willing to say, okay, if we break down here, you've got to be open to that as an opportunity considering how the structure has ultimately printed out. Let's take a look through the lens of a couple of Fibonacci's. These are never quite the same as the S&P or NASDAQ, but as we know, 38.2 is the bullish high or low here. Wouldn't be great for a retest because technically you'd be underneath that 200 level. I would tend to think that the lower high is an offering here. Now all of a sudden we're dealing with a weekly head and shoulders, so that's the threat to the downside. If we can continue to hold this, obviously we're just over the bullish 38.2, which is solid for our buyers. Let's go out to a 5-year chart here because what I want to illustrate next is that the previous target, or the target should be, I should say, as we continue, if we continue this move in the upward direction, closer to 235, right? You don't want to cherry pick the exact all-time high, but 235, that of course would be bullish for the broad market as a whole, the broadening nature of the market rally, right? That's sort of what that means here, and it would be a huge tailwind for the S&P 500. Let's take a look through the lens of the weekly anchored view apps because these are a little bit more meaningful out of the IWM. We do not want to extend that to the left. We want to remove it. And taking a look here, this huge cluster, like as this continues to drift in the upward direction, if it continues to drift in the upward direction, I'd love to see these, over time, creep higher and then offer eventually confluence at the top end of the range. We're not there yet, but that's the goal out of the IWM weekly time frame chart. If you're constructive on small caps, you'd like to see these things start to curl in the upward direction, then offer huge support on any potential. Let's say we get a break, then a bigger retest of 200. That would be very meaningful if the cluster of anchored view apps were offering confluence there. Let's bring out now the volume profile, and we'll take a look from this point of view, pushing away from the highest volume node, moving into the low volume void. Remember that is this up here, and the target would be loosely aligned with not quite 235, which is the top shelf over here, but instead the midpoint of that range around, let's call it 223 for round number 6. So 223 upper target if we can continue to drift through the low volume void over there. Let's move on down to the daily time frame chart. I really think that the weekly is most important out of the IWM, which is why we spent some time on it. But daily time frame chart, we can speed up a little bit through. So huge move back in the upward direction, giving it back though into the end of the week, unlike what we saw out of the other two indexes, right? Most of those remained over the upper edge of the weekly expected move, whereas the IWM pulled back further into its range here. So the key level to watch is going to be at 204. If we can stay over 204, that's the neckline of this as a head and shoulders, which led to a breakdown. FOMC, color me surprised. I thought that we were going to look for a lower high underneath. Obviously, we did not. So we want to see a higher low above that now. And once again, that key level is 204. It continues the daily trend in the upward direction, looking for higher lows. There it would be. The upper edge of this week's expected move is at 208.83. The lower edge of the expected move is at 201.31. It would be an equal low to the low consolidation of the Monday and Tuesday session from last week. We did technically a very mild gap up on Thursday, tried to get continuation, then pulled back into the range. So if we're thinking about stronger sellers, stronger buyers, I would really look at the Wednesday session, and obviously we know small caps are more sensitive to fundamental data. So it makes sense that it saw a stronger move on the FOMC, where Jerome Powell was, in my view, way too dovish. So we'll see if he needs to correct that with some of the commentary that he's scheduled for on Friday of this upcoming week. Government workers are scheduled to work, even though it's Good Friday. So we are getting a PCE report and Jerome Powell speaking on Friday. We'll get to the economic calendar in just a moment. Here is the hourly time frame chart out of IWM and small caps. What you can see is just clear as day, same concept, right? Really 204, staying above that, looks bullish, looking for something that does this. We'll remain neutral on the broad market, healthy for the S&P 500 if we break down underneath. A little bit more skeptical for the S&P. I mean, the QQQ could break out of its daily balance range. Let's just quickly go back over here. Just to give you the intermarket dynamics for this week, if the QQQ breaks out of this range in the upward direction while the IWM is possibly failing 204, something that looks like this, I would have to be a little bit more neutral on the S&Ps. We know that the S&Ps are primarily driven by the tech cohort anyways. So, really pay attention to the divergence between the IWM and the QQQ. You can see just on the Friday session how different they were. IWM down 134 basis points, whereas the QQQ was 23 basis points in the green, right? So 204, I think, makes a lot of sense. Thin structural retracement, bigger line in the sand would be here. As long as these buyers are content, technically speaking, this is okay. It would be sort of ugly. It definitely wouldn't be preferred on the daily time frame chart, and the hourly would certainly remain in a downtrend, right? You have highs, lower highs, lows, lower lows. Continuing here is a lower low. You would be looking for a reversal over 202.75. That is what we've got. Let's take a look at quickly the anchored view apps intraday out of the IWM. There we go. And we do have a cluster around that 204. So if we can hold this, It seems pretty good. That would be decent to me, seeing a hold of 204 because of the anchored view apps. Let's quickly throw on our Fibonacci's coming in from the low up to the highest high of the most recent move. 50% retracement is sort of baked in there. 61.8 is fairly close to that 202.75. Let's take a look at the Russell internals, and then we'll sort of wind things down here with a brief glance through some supporting evidence. But Russell internals, again, not as bearish as they could have been considering the weakness on the Friday session. We did not get to substantial volume outflows. The ADD, or in this case, the ADRLD, moved towards trend lower zone, but not into it. I would say that this breakdown is substantial, though, in terms of the magnitude of going from positive to negative, and then on the the cumulative build out of the tick, also much more substantial in the downward direction. Typically, out of the tick, I would say that 2,000 is the mark that you're looking for, unlike the 5K in the S&Ps and the NASDAQ. So stronger sellers, yeah, would it be unreasonable for a full test of that 204? I think that that's absolutely in store for the early stages of this coming week's worth of trade. Unfortunately for the bears, I just don't think that they have, in the grand scheme of things, enough really going on here. I think that, there's plenty of opportunities to continue this as sort of a major ascending triangle, if you were to look at that through the lens of the weekly, right? So that is the IWM cash. Let's take a look at the Russell futures on the market profile. Any big nuances or takeaways here? I would just say that this looks like liquidation break to me. Right, liquidation break is really not stronger selling. It's just, and which is kind of interesting because we just saw the market internals, right? But it's really selling, liquidating off the open, and then not really doing much the rest of the day. So you had trapped buyers maybe on the Thursday session who were like, let's get out of this thing. I think we were a little bit too optimistic on Powell's speech, and then we really don't see follow through to the downside. And the reason that this is important is because this is thin structure, right? It's really not much that should show us support in that general zone. So are these stronger sellers, or are they just nervous longs with terrible location? Based on this evidence, I would tend to align more so with nervous longs. And even if we go back to the profile here, I should say platform, this is, you can get that based on nervous longs. It's really the volume flows to me that are not substantial, which would support the idea that not really stronger sellers and still more so liquidation break, right? So that is going to do it for the Russell side of the market. Let's go back on over to the S&Ps and let's briefly talk about the weekly performance of our sectors. Leading the pack are industrials, followed by semis, then consumer discretionary. So posture seems to be risk on as we're breaking out from that range high on the S&Ps. It would have been better if the XLK could have actually outperformed the S&P, but no surprise there considering what the QQQ did on the daily time frame chart. It is really great to see financials printing a new all-time high as well. Let's jump into these structural charts. The only underperformer on the week is real estate, obviously extremely rate sensitive. So here we go through the sectors. Industrials, new all-time high, no problems there. Semiconductors looking good up and over this level at 224, all good there. If we were to break down, not the end of the world, possibly a lower high, right? And maybe if we get a breakdown through the lower low underneath 212, we'll have larger concerns, but as of right now, in the grand scheme of things, it's fine, right? This is a very strong weekly, daily uptrend on the SMH. Here's the XLY. Island reversal, maybe something to pay attention to, but if we can find support here over 182, not the end of the world. Higher lows keep bullish consolidation, making building blocks in the upward direction helpful for the S&P 500. Here's the XLF, pulling back aggressively on Friday, but new all-time highs. What else can you ask for? I mean, certainly an opportunity for a constructive higher low. I'd be watching early on in the week to see if 4120 can act as a higher low. If it does, that would be very bullish for the broad market. We know that the XLK didn't really perform to the magnitude of breaking the S&Ps out. The XLF certainly did. So if the buyers are going to continue to stay strong in financials, third heaviest weight sector in the S&Ps, right? It's also a risk-on sector. That would be really bullish. So this is a top watch as we head into the coming week at 4120. Next up is communications breaking out of the balance range, getting that continuation to the next weekly target, 8215. Higher lows here, good to go. Nothing but bullish things to say about communications. Possibility for a pullback, yes. Bearish 3-bar play on the Thursday-Friday interaction, but the grand scheme of things, right, not really going to be enough to drag down your S&Ps by itself. Let's move over to the XLK, very similar to our QQQ. Looking for the range break in the upward direction to remain as bullish as possible. That's up and over 211. Higher lows there look good. Any continuation here, consolidation, I should say, over 208, also looking good. Following for that in the future. The larger concerns emerge when and if we get a lower high underneath 208 and then threaten the NVIDIA earnings gap one step at a time. As of right now, it doesn't seem like a primary outcome, but open-minded, right? Open-minded. This would be preferred, and something that looks like this. I'd like to see if we can find buyers there, at least into the end of this week, considering it's a shortened holiday week. You're also going to get the 50 SMA offering Confluence as potential super support. Next up, let's take a look at the XLE Energy. Moving in the upward direction, monthly breakout takes place over 94.25. We are not there yet. Remember that this is inflationary, but upward pressure is upward pressure. It's bullish for the S&P utilities. People are talking about utilities maybe outperforming a little bit. I mean, on certain days, it was earlier on in the week, right? But as of right now, it's still just stuck sideways in this range. It's technically over the neckline of this as a double bottom. Maybe we're getting the inverted Man Ray pattern, something that looks like this. But one step at a time. It's certainly not outperforming to the degree where we're concerned, so we're moving along. Next up, XLP, very mechanical uptrend remains in place. Double top possibly, but don't jump the gun. It's got to be underneath 75. If it breaks down underneath 75, what do we know about the XLP? It's D for defensive, and it's a lightweight sector. So this does not strike me as the end of the world if, that's the asterisk, right? There's always an asterisk. There's always an if we're getting outperformance continuing from the XLY, XLF, and the XLK perhaps breaking out of the balance range. So this is not the end of the world, only if we are getting sort of outperformance from the risk-on sectors. If this breaks down and the XLK is also breaking down and like utilities are then at the top of the list next week, yeah, much larger red flag, run for the hills in the S&P. We're just not there yet in terms of the structure that we can at least identify. XLB materials scratching the all-time high, pulling back ever so slightly. Not the end of the world. Larger concerns will emerge when and if we are firmly underneath 90.30 for a stronger pullback, something that can retrace this thin structure. We're not there yet, but it's worth keeping an eye on into the coming weeks worth of trade. Materials, the lightest weight sector in the S&P. It's not going to make or break us, right? Next up, XLV healthcare. This is the second heaviest weighted sector by market cap, so certainly worth paying attention to. Descending triangle is in force. This as a lower high is somewhat menacing. If we break down underneath 144.80, I would be watching this in conjunction with your XLF to really determine what's going on this week if the XLK remains inside of its balance range, right? You're going to get a push and pull between financials and healthcare if the tech sector remains more sideways. So that's the dynamic to pay attention to here. And the breakdown point out of the XLV is 144.80. To me, does look like a threat. It really does look like a threat. Lastly, we've got the real estate sector, and this is just totally sideways. It's very rate sensitive. It's the only laggard, but it's still just stuck inside of this as a range. Next up, let's take a look at the sector ratio grid. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. XLK is still a small yellow flag. It is not outperforming at all, and you can just, obviously see this on the week. So just more so sideways than anything else. It's not the end of the world. It's not a red flag yet. That's why we called it yellow. Financials breaking back down. Obviously, Friday was pretty aggressive to the downside, down about 1.25% there, but still an opportunity to catch for a higher low over the somewhat flattened out 50 SMA. If we can hold that okay, if we start to go more sideways and chop around the 50 SMA, that would start to turn into a yellow flag considering the dynamic between the XLV and the XLF that we just talked about. If the XLV breaks down, technically it's a D for defensive sector, but if the S&P breaks down with it and healthcare is not breaking down as aggressively, this will tick higher to kiss the 50 SMA. Right, so watching that sort of interplay between healthcare and financials. Those are the largest sectors that I would be concerned with, again, if the XLK remains sideways inside of the balance range. What do we see over here? This, certainly could be better. We're not getting any help, any love from the XLY. Are we risk off, though, is a key question to ask, and the answer is no. The answer is no. Not really. Maybe inflationary here, and certainly not out of real estate. Let's take a look at some specialized ratios to continue to answer that question. Not risk off, but certainly looking for the break to return to full-blown risk on. Let's take a look at the, we want this here. Again, not risk off, that would require a breakdown here, but not quite risk on in its fullest sense. Breaking this resistance trend line, firmer acceptance over or towards these equal highs would be better for a risk on look. But again, if you're trying to short this market, you probably want to see this underneath that flat bottom first. Let's take a look at apples to apples, XLY, XLP. It's back above this magic sort of blue line, if you will. It seems like it's clinging to it for everything it's got. Opportunity for a higher low here, yet a lower high here. So still neutral on this. As long as it's clinging to the line, I would tend to think that this is constructive over time, right? And I would really only be more bearish on this ratio if we're clearly breaking down to tag 223. Let's move along to SMHXLV, and this is also looking bullish. This is looking risk on. So all of the indications that I can see so far are definitely not risk off. We require some more breakdowns to flip to risk off, but the risk on is sort of pausing here as maybe we're getting some laggards and the XLK just not really breaking out of its balance range, right? Let's move along to the dollar and see what's going on with the currency. And you can see we're breaking in the upward direction, in theory, putting downward pressure on the market. That's exactly what happened on Thursday and Friday, right? So as the dollar moves higher, it tightens financial conditions and a mild pullback after a gap up to all-time highs. Very reasonable. If this breaks out up and over 105.65, larger concerns would emerge. I would probably even start calling for like 104.85. If we take that out, if we take out this prior pivot top, that might be a little bit of an accelerant in the upward direction for the dollar, furthering downward pressure on the markets over here. Let's move on over to gold and see if this has any insights for us. You can see that we've pulled back aggressively after breaking out over that high. I would tend to think that gold could be a short, possible short. Again, possible short with small size. If we break down underneath this, why was gold unable to stick on the breakout here, right? That really is a question that I have. And I think that gold, a lot of people chased it in here. Anybody late to the party is possibly looking to unload on a break even or a very small loss if there's a stop run underneath that level. So the number is around 21.55. Breaking down underneath 21.55 would be aggressive to the downside out of gold. And in theory, what that means for the dollar is upward pressure, and you want to play it out. That means downward pressure for equities down below. Let's move on over to the inverted ZT, talk about the Fed a little bit here. You can see that the 2-year yield is still stuck near this line. If we break down aggressively, we're expecting harsh cuts coming in hot and heavy, like the Fed is going to panic. If we're just sort of neutral and maybe drifting, something that looks like this, not yet a panic out of the inverted ZT. I just realized we skipped the TNX, which of course is the 10-year interest rate. And this is also worth talking about. It sort of ties directly to the Fed, so I don't think we're too far off, but this is a possible higher low at 42. Any consolidation up here, break higher low, and then, off to the races, oh boy, that spells trouble for a QQQ that's really stuck sideways in a balance range. So watching interest rates here very closely, and I think that some of the takeaway from this most recent FOMC meeting, Jerome Powell has kept his dovish face on. He's continued to talk about 3 cuts for 2024. I mean, if the market's going to do his job for him and tighten things without him having to explicitly be the bad guy, the 10-year and the longer end of the curve is going to break out here, signaling that the neutral rate is much higher than the market thought, making operating conditions a little bit more intense, right? Especially for companies who rely on borrowing capital. So seeing the 10-year break out here would be bearish. Just at the end of the day, it's bearish across the board for the market. So very interested to see if this turns into, right? Because we're right on the cusp of this interaction. Is it a double top rejection, and do we crack this neckline back in the downward direction for an equal low, or does this consolidate up here and then offer up an ascending triangle? Right? Which is it going to be? That's our job to basically figure out here. And as of right now, I would tend to think if we're over 4.2, the risks are higher for something that does this, which would be bearish and probably kick off a stronger pullback for the S&P marketplace, the NASDAQ marketplace, especially the Russell 2000 small cap marketplace. So now that we sort of understand that, let's take a look and take a crack at the Fed tracker tool. And really, there aren't many things to update over here. You'll notice that we have continued higher odds for a cut in June, like 66 to 70-ish has been the hovering rate or percentage probability, I should say, for a cut come June. And I'm still at odds with that. I don't necessarily buy into the idea that June is the right time to cut rates. So we'll see if the tracker tool continues to suggest otherwise, if there are people smarter than me. Let's take a look at the calendar for the upcoming week's worth of trade. This is last week, just pointing out that the manufacturing PMIs came in decent. They were over 50, which is, of course, expansion, and that of course is going to be not an indication for our recession, folks. If you're thinking about a deep, dark, dirty recession, oh my God, markets are going to zero, PMIs would be under 50, and that's not what we got last week. Unemployment claims also fine. The forecast was for 212, we got 210. This coming week, as we know, we have I was going to say Easter, Good Friday on Friday, but we will be getting the core PCE as well as Powell speaking at 11:30. So please be open-minded to that. You're also going to get a couple of other Fed speakers in here. Waller, and I think if I were to turn on the yellow, you're also going to get some more Fed speakers as well. Yeah, so you get Bostic. That might be it. Yeah, it was just Bostic and Daly. So there you go. So take a look at those things. I would say that the largest issue would be your final GDP, which comes out on the Thursday session at 8:30. We'll be live for that up in the Penthouse Suites. Durable goods orders, hit or miss. Consumer confidence, hit or miss on Tuesday in terms of the magnitude of the reaction. The larger deals will be unemployment claims, the final GDP, as well as down here, Powell speaking, and core PCE on Friday when the market is closed. A little sneaky there from Mr. Powell. Let's take a look at the calendar in terms of earnings. If you want to get your popcorn out and take a look at GameStop after the close on Tuesday, be my guest. But there's really nothing here that really grabs my attention and says, hey, pay attention to this company. There's, you're going to learn a lot about what the market is doing. Nothing crazy here. If you want to look at high-end furniture, restoration hardware, so if you're trying to gauge like which cohort of consumers is really breaking down, Don over at TheoTrade actually had a great little piece on this. Louis Vuitton showing some weakness. I'm curious to see if restoration generation hardware is going to show some weakness as well. Really, expensive furniture there compared to, I don't know, if you're just thinking about online retail shopping, right? So anyways, enough of that. Let's get back on over to the platform and finish up today's video, which I don't know how short it's ultimately going to be. I might have just, ended up rambling myself in a circle here, but TLT ratio to the S&P is certainly not signaling any signs of flight to safety. So that means risk appetite for equities down below is just fine. Let's take a look at bonds in relationship to themselves. And these continue to drift into very nuanced short-term uptrends here. I'm very curious to see if these higher lows stick around the 50 SMA. We had this conversation on Wednesday. If they do stick for higher lows and we continue to drift in the upward direction, what this would tell me basically, again, is that the longer end of the curve probably needs to play pickup, even if the shorter end of the curve remains elevated as we're sort of navigating, does the Fed cut or does the Fed not cut in the June timeframe meeting. So what that means for the market ultimately is if these drift higher, probably looking for downward pressure, a little bit of a pullback, right? It's not actionable in terms of like go out and short the market, but just an understanding and a context piece. Next up, we have credit spreads. These are continuing to drift lower. So that, of course, would be risk on for the market. This is bullish for equities down below. When we look at the HYG in isolation, it's starting to mirror a little bit more closely the S&Ps. You can see that we have a low and a higher low over here, a low and a higher low over here, a high and a lower high into the close, a high and a lower high into the close. So we're all good. And as we've continued to reinforce, the larger concerns would step in when and if HYG breaks down underneath 76.60. Let's take a look at Bitcoin and see what's going on with the digital gold, pulling back a little bit more aggressively. Interested to see if this now turns into a head and shoulders, right? You can certainly start to see something that looks like this. If this breaks down underneath, 69.70. If we can break down underneath 60, 970, looking for some thin structure retracement, you get a little bit of support here at 52.791, call it 52.8 flat if you like nice round numbers. If you can find support there, it's a beautiful opportunity for something like a weekly higher low. So 52.8 would be the level. Let's just clean that up. Round numbers only. You guys know the rules up here in the penthouse. So much for being quick on time. Let's move along and take a look at what's happening in terms of new highs versus lows. Sharp rebound in the upward direction is bullish. Let's quickly zoom in. Bullish here. Let's take a look at the SPX A200R. This, of course, is also bullish, drifting in the upward direction. SPX A50R, mild pullback. One thing I would just remind you out of this is, all of these are oscillators except for the new highs versus lows. But SPX A200R, 50R, 20R, they're all oscillators. Let's take a look at like max time interval here and go out to like a monthly chart and just show you that it's not unreasonable for pullbacks off of this zone, right? When you have over 80% of the companies in the S&P over the 50 SMA, of course, it's bullish, but you can only sustain that for so long before there's some give and take, right? Ultimately, the 50 SMA will catch up. And even if there's just a mild pullback to, I don't know, let's just pretend a 75 SMA, not that I would ever use that, but you get the idea, you're going to be underneath it ever so slightly, right? So that's the concept here. It's bullish, but does it mean we could see a little bit of a pullback when we get into contrarian zone? Absolutely. We're not there yet, but it's something to start paying attention to. Here's the RSP equal weight S&P 500 breaking out to a new all-time high with the weighted S&P. This, of course, is bullish in terms of breadth. Similar commentary over here out of the QQQE. It tried to make that all-time high, as did the QQQ weighted, or the NDX if you want to use a weighted, right? So all good. These are not too far out of sync. If we take a look at the Dow Jones Industrials versus the transports, I want to point out the attempt to the top of the balance. So I'm very curious to see if we can get a successful breakout here in transports. That would support more of an idea of continuation out of industrials. Whereas if this turns into a huge look above and fail, now all of a sudden I have to start thinking about larger implications for the broad market as a whole. Wouldn't mean go out and short the S&Ps, but certainly thinking about the opportunity for the S&Ps to pull back more aggressively if transports did something like that and industrials did not sort of follow, right? If these continue to be divergent after something that looks like that, that's a little bit painful for the S&P look. Let's move into volatility here and really finish it up before the core list of companies for trade ideas, and then I'll check in on see how we did on time. Probably not great, but here's the breakdown of the support trend line. Breakdown from that support trend line is bullish. So in theory, the gap up on Thursday, makes total sense based on what's happening here in VIX. Volatility is not an issue. However, if you're contrarian, if you're looking for a pullback to emerge, we all know that 75 is complacency zone. So if you've made it to this point in the video, first of all, congratulations listening to me, rant about the market. But second of all, this is really what we care about. If you're contrarian and you're looking at this 75 level complacency zone, all it's going to take is a little bit of downside activity. If this catches big support off of 75 in the VVIX and lights up the VIX itself, I think you could be in store for a pullback through some of that FOMC structure that is maybe a little bit more rapid than what folks are maybe anticipating. Now, again, we don't have stronger sellers entering the market, but could you see a little bit of liquidation there? Seems reasonable based on the VVIX. So a back pocket idea for the sellers. Again, not enough to just short outright the market. You got to see the price action action first in the S&Ps, but this would be a supporting piece of evidence if you see this tick massively off of the 75 level. Next up, volatility futures, and then we'll move into the core list of companies. Big contangos across the board, meaning that money managers are certainly fine allocating capital now instead of waiting. That means bullish inflows or volume bullish inflows for the broad market as a whole. Let's jump on over to the core list of companies and see what's going on here. Hourly charts for all of them. Let's get rid of those anchored view apps here and just keep it brief. So Apple, big bearish engulfer. We've talked about sort of the pain points of Apple in the pre-market preps. As of right now, I'm thinking about the opportunity for lower highs underneath 173.75, looking for a rotation in the downward direction to target 169. You can prove me wrong, buyers, if you produce a higher low over 173.75. Keep it simple out of Apple. You have a thin structural retracement if this is the case, and your target would just be that high of day from Thursday around 177.40. So keep it simple until proven otherwise out of Apple. If it's just consolidation down here, break lower high underneath 170.60 is the setup. Next up, Microsoft. What do we see out of Softy? Sideways consolidation at the all-time high. Again, keep it simple. Sideways consolidation, break higher low or lower high underneath. I would be very cautious of the shorts in this area. And the reason being, we talk about this every single morning, is that there's prior structural levels in here. I don't want to get too level happy and have something at every little increment on Microsoft, but any lower highs, you could easily find support and do something that looks like this. You could find support and do something that looks like this. So because of the strength of the uptrend, because we're sitting at all-time highs, I really would try not to align with the bearish trade out of Microsoft and instead say, how can we get involved into blue sky territory? So we'll keep it simple there. Next up is GOOGL. What's going on with GOOGL? Taking a look at this through the lens of a possible cup and handle. If we can continue this consolidation here up and over the top of the cup at 151.15, brings us to the all-time high at 153.76. So watching out for that. Consolidation over 150 keeps the buyers in control. If we slip this, it's the opposite of the very classic setup we always talk about in terms of a squeeze on the open. This would be liquidation break, right? So opening drive gets us here. Sideways consolidation all afternoon. That means any buyers late to the party, if they're going to close out of this thing, if they're like, I don't really think I have the greatest location, their stops are all underneath this low. So underneath 150, it's the exact opposite of what we had here, right? Whereas this was a squeeze in the upward direction, this is a liquidation break opening underneath in the downward direction. And your target would just be the base of the cup down here and the top of the gap at 146.25. Don't forget that Google is actually, we'll go to the daily chart for this one, making a very impressive recovery effort off of the upward sloping daily 200 SMA. We're over this key level here. We're trading back up near the all-time highs. Very, very impressive. If the sellers were really going to make something stick when all that Gemini news was going on, this was what we were looking for, sellers were looking for, and it simply didn't happen, right? So as of right now, you've got to be a little bit more bullish than bearish out of Google. Next up is Nancy. What's going on with Amazon? Here it is on a daily time frame chart. It actually, let's go to an hourly. I think it makes more sense. We can see that the daily range was there. You can see the hourly ranges here. Very clear. Any consolidation over this 176.50 is over the top of the 50% mark of the range, breaks higher lows on the daily up and over 179.50, trade into 185.25. Plenty of range in the upward direction. You don't have to be the first one in the door. If we slip to the downside, again, this is probably not a short just because I personally don't want to get involved in this really choppy range, but instead, this maybe is like look above and fail. If you can find a short like here, so I guess the idea would be, if this is going to act as a lower high, if you can find a rejection intraday up here, and then trade it back towards the midpoint and hold on to the bottom end of the range, fine. Look above and fail, right? Target's always the bottom end of the range. But if we're just in here and then just like breaking down a little bit, I would not be aggressive if you don't have decent location with a clear stop over the top of the range. And instead, the stronger short might be something that looks like this to close the gap underneath us under 174. Next up, we've got NVIDIA. The one stock to rule them all is back off to the races in the upward direction. If you tuned into the pre-market prep on Friday, hopefully you caught a piece of it. We were talking directly about 922 out of NVIDIA. Let's just do this thing justice and go on down to a 5-minute time frame chart. I mean, can you get anything better than that? Honestly, can you get anything better than on Friday? First little pullback, great. You could either get the higher low here, you could get the equal high breakout here, or you could get the higher low above. Just a beautiful setup out of NVIDIA. So playing very nicely in terms of the structural patterns. As we continue to look at the chart, I mean, on the hourly time frame, you can still have the same opportunity on a higher low that holds over 922 coming from this higher high, or you could just look for straight up continuation over the highs of the Friday session through the thin structure into the all-time high at 972, loosely, 972 out of NVIDIA. Stronger sellers have something going on. If this turns into a head and shoulders, it's also a look above and fail on this as an entire balance range. That would be your lower high back down underneath 922 as a level. Honorable mention to AMD. Let's quickly take a look over here. Not much going on. I would really consider this a sideways range. We're sort of in in the midpoint of that range. It's slightly constructive if we can stay over the 170.855. The reason I would say that is because obviously on Friday, we opened on a gap down underneath the Thursday session low. So early stages rejections, then afternoon broke above. So this recapture of the level does strike me as a step in the right direction, but is it a tradable long? I'm not convinced yet. It really does strike me as a more neutral range, and we are technically in a daily downtrend. We can start to reverse that on higher lows over 183.60. Moving along to the metaverse. What is going on with Zuckerberg's fantasy land over here? Looks good. This is a balance range. This is a break. This is a higher low. Looking for continuation in the upward direction. If we can get back over 510.75, looking to navigate towards the all-time high at 521. If we just consolidate underneath and break down, I'd be interested in this as a double top, but perhaps underneath the top of the balance range at 501.50. So shorts would look something like this, back down towards the bottom of the range overall. When I say range on Meta, I'm referring to this area right here. Next up, we've got Tesla. What's going on with Mr. Musk? And I would call it the boring company these days, drilling in the downward direction. Huge offering of a lower high. Not beautifully up against the bottom end of the range, but still highs, lower highs in here. Consolidation, I mean, the structure is a little bit lackluster. I would be thinking about, again, just another lower high, to be honest with you, offering maybe very loose head and shoulders. I mean, the better trade would be the short underneath this area, some sort of lower high under 165.75. The structure in here leaves a little bit to be desired. I mean, technically speaking, you could probably pull off a level at 170.85 and say if we reject that, it's just a gap fill reversal from Friday's gap down, something that offers a lower high, trade in the downward direction, tight stop, entry, and target. So maybe there's an idea that looks like that, but in the grand scheme of things, when I look at Tesla like this, it really leaves a little bit to be desired in terms of setting something up. So maybe the lower high is like the most attractive thing I can see, or a breakdown through these lows as we just discussed, also on the table. If you're going to be bullish out of Tesla, it's got a lot of work to do. I mean, the gap down on Friday was certainly detrimental. You were trying to build out these series of higher lows and maybe higher highs. It's been sort of unwound on Friday. So on the long side, a little bit cautious. Don't really see anything clear here yet. I would probably want to see acceptance over 173 and then a different setup emerge. Maybe like something that does this back into 182. We're just not there yet. Next up is Netflix, last but certainly not least. Looking good here out of Netflix. Another golden goose, if you will. I mean, NVIDIA, beautiful, and also Netflix, beautiful. So retest on Thursday of the breakout point at 623. Friday, little inside bar there. If we can get that, sorry, not inside bar. Let's go down to the hourly. There we go. A little bit of a hold, rather, of that 623. So that lower wick pierces, comes back above, and you can see this afternoon higher low above as well. Sets up the move into next week up and over that as a neckline of some sort of double bottom. Let's bring out the tool. Let's pop that in there together. Let's go 627.50 for round numbers only up here in the penthouse suite. So the idea would be this right here, trades up to this high, and then of course your larger target is 644.75. All right, I've got a couple of trade ideas for you. The first one is going to be on IBM. Can you imagine? I've got all of this up in my noggin. IBM is up first. What do we see on the daily time frame chart? Certainly looking at a maybe cup and handle. We talked about it this way a little while ago where this was a 3-bar play in the upward direction. However, what do we see now? Look at this as an opportunity for a lower high, descending triangle, flat bottom. If we can break down underneath 191, looking for the rotation into the breakout point here at 186.25. Here it is on the hourly time frame chart. Thin structure to retrace. Very interested in IBM underneath 191. Next up, PG, Procter & Gamble. What's going on with PG? You can see certainly this very tight consolidation range up here. I think it could go either way. If we take out the highs, great blue sky territories, looking for a move in the upward direction. If we take it out to the, I believe it's all-time high. Sorry, no, just shy. All-time high would be the target, 165.35. That's the upswing out of PG. I knew I had to double check that one, so it's not quite all up in the noggin. To the downside, something that looks like this, I could imagine some sort of retest of the 50 SMA, or if you just want to be a trendline trader, right, look for something like this, very quick snap to it. If we can support off of it, it really just keeps the trade alive. A breakdown of the trend line maybe is your deeper play into some of these equal lows, 157s, 158s. That's a possibility, but really just making note of the tight range. I would be more partial to the upside, even though we have red bars, because we've already experienced a look below and fail, and we're continuing to consolidate sideways. Next up after PG is going to be, what was it going to be? MRK. MRK. We can take a look at MRK. Merrick. We can see here a flat top. If we break out over it, looking for something that does this, over the 50 SMA, over 124.75, targets 127. Let's take a look at the hourly time frame chart. I think the setup is as clear as maybe mud. If we can hold up over 123, that builds out your right shoulder, and then we're looking for follow through in the upward direction. I remembered what it was. It was MU. I knew I was on the right track with M's, but MU is up next, and Addy Stacks. Thanks for making us take a look at this one on Friday's session, because the trade here was also fantastic. I mean, look at the look below and fail. If we take it on down to a 5-minute time frame chart, what we'll see here, let's zoom in a little bit further on that. There you go. So these higher lows in here really started to get us going up and over the neckline of this as a 5-minute double bottom. And you can see we got a little bit of continuation through the end of day move. So as we walk forward, what's the continued play out of this one? It's just watching for, if the hourly chart pulls back further to 108.75, the swing back in the upward direction towards the top end of the range, right? That's your look below and fail playing out in its entirety. If you look below, you always target the opposing end of the balance. And if we were to break out over 112.68, it is blue sky territories. That's going to do it for today's episode of the Weekly Watchlist. I'm not sure how abbreviated it ultimately was, but hopefully you enjoyed it. If you learned anything new, let me know down below in the comment section or by giving the video a thumbs up. Remember, we're on the road to 100,000 subscribers by May. That's what we mean when we say 100K by May. Let's see if we can do it. I think we're about 20,000 shy, and we've got a little over a month to make it happen. So it is up to the people. The people will speak, and we will see what the results are. Remember, we will be live up in the Penthouse Suites at 8:15 every morning this upcoming week's worth of trade, and we'll see if we do something special on the Friday session for Good Friday when the market is closed. With that said, everybody, have a green trading week.